Hello, everyone, and welcome to this Tresle webinar. My name is Joel Keeler. I'm the CEO of Tresle, and I'm very excited for this presentation today. Joining us today is Ken Kubec, VP of Acquisitions for Tresle, the world's largest Amazon acquirer. Managed from its headquarters in Massachusetts, Tresle buys and operates third-party sellers within the Amazon ecosystem. To date, Tresle has bought over 100 FBA businesses and is the fastest profitable US company ever to reach $1 billion valuation. Yes, I said with a B. They recently closed 2 large funding rounds in 2021 thus far, kind of to further fuel their growth, including a $500 million, $500 million round in January, followed by a $750 million round in February. So if you haven't guessed it, we're going to be talking about Amazon businesses. Specifically in this discussion, we're going to be covering kind of the opportunities that exist within the Amazon ecosystem, what buyers look for in order to exit a company successfully, and broadly speaking, the next steps in e-commerce. And then we're going to wrap this up with social media submitted questions that you guys submitted, and thank you guys all for doing that. So without further ado, thank you so much for joining us, Ken.
Yeah, thanks for having me. Excited to be here. Lots to discuss.
Yeah, absolutely. So maybe you could tell me a little bit about yourself, your background briefly, and how you got involved with Tresle.
Yeah. So I spent the first decade plus of my working career in investment management on Wall Street as an equities analyst and portfolio manager, investing in small cap growth companies, primarily technology stocks. After that run and kind of stress levels, I kind of just got burnt out of the grind and earnings seasons and living and dying by the vagaries of the emotional stock market, and wanted to kind of pivot my career trajectory into something that was more tangible and hands-on, where I had more say in the outcome and impact in the outcome on a day-to-day basis. So that kind of led me to looking for opportunities in the startup space. I was then put in touch with an individual that kind of ran an Amazon software company and also had an Amazon business. And he was looking for someone to come on and run the Amazon business while he focused on the software company. And it was a great fit for me. It was $15 million a year or so wholesale business. So it was similar to what I was doing before. Instead of picking stocks, we were picking brands and products and kind of put a whole system and framework in place for product selection and inventory management. And really it's kind of similar skill sets. And then, randomly, about 2 years after doing that, learning a lot about the Amazon, marketplace, how to perform on it, as well as the ecosystem, kind of leaning on the software side. I actually just randomly got connected with Carlos, one of the co-founders of Tresle, I went on an interview and I interviewed with his neighbor and really good friend, and he was gracious enough to connect us. And then they were looking for someone to come in and help run the acquisitions. At the time, I think they had purchased 3 businesses, had to close their first $7 million debt line of credit, which seems pretty small relative to the capital raises recently. But you got to start somewhere. So it was really, I had the purview of living and breathing in the Amazon ecosystem 2 years prior. So I knew that there was a massive opportunity in consolidating a lot of these third-party sellers.
Yeah, and this was back in 2018, you said?
Yeah, so this was, I think I first talked to Carlos September of 2018, and I joined in November of 2018. So it'll be 3 years this November.
Okay, wow. So a veteran in the Tresle world.
I was laughing. We were laughing earlier. I talk about it. I'm sure most startups do this, are the same way, right? It's just the days, seem long and the years are short. It's the same analogy with kids when you're raising kids.
You blink and there goes the time, right?
I mean, we've gone from, I think I was the 10th person overall in the company back then, and we're over 1,000 globally now. So
nice. Well, yeah, thank you for that background. So I guess the first question that I have is, broad, but I guess it kind of goes to the investment thesis or kind of just the concept around the company in general. And it just broadly speaking, why Amazon businesses?
Yeah. So interestingly, the first thesis, I think there were a few iterations, but the first was actually D2C brands, so micro D2C brands. So Carlos, one of the co-founders, along with Josh, they had crossed business paths prior, and kind of we're always thinking, hey, we should work together, like, very complementary management leadership skill sets. And Carlos at the time was running a Facebook ad, one of the leading Facebook ad agencies. And that's what was the genesis of, hey, our agency is taking these brands from 1 to 5 million in revenue. There's an opportunity here if we can go in and buy them when they're at 1 million and scale them up right through advertising experience and know-how. And Josh is, venture capital turned operator to, entrepreneur advisor. So he had that skill set. And so as they were doing that, Josh got put in touch with Casey Goss, founder and CEO of Viral Launch, which is a third-party provider of data for Amazon sellers. And they started talking, and they just kind of the stars aligned, and Josh and Carlos got opened up to the Amazon ecosystem. And at the same time, a lot of Carlos's clients with his ad agency were saying, hey, can you guys run Amazon ads? And so they kind of started talking like, hey, let's dig into this, the Amazon ecosystem, and maybe there's an opportunity there. And that's what really precipitated. And then the first thesis on Amazon was, let's buy the brands and the products that are kind of on the bottom of page 1 for the keywords, and let's use our marketing experience and capital and move them to the top of the page. And so the first few acquisitions were actually under that thesis. And what we found out is that's a lot harder to do in reality versus in theory. And so we said, hey, well, why are we going to waste all time and energy on a kind of a wide cone of outcome event of can we get them there, and can we catch up with the competition? Let's just go buy the leaders and then continue to expand their leadership position, and that's kind of where the thesis sits today.
Yeah, interesting.
And so the ecosystem, I mean, Amazon is just different, right? I mean, there's a lot of differences. I think one of the most attractive is you pretty much have set unit economics, which in D2C, right, it's all lifetime value and customer acquisition cost. You got to pay and acquire the customers. On Amazon, they're there. You just gotta capture them, right? And you have to set kind of fee structure outside of the variable marketing costs. So
yeah, and I would also assume that there's also apples to apples type comparison, that they're all on that same, obviously different verticals, et cetera, but all on the same platform that you can compare financial performance compared to somebody's on different accounting year end versus this, and versus a different software, and accrual, cash, different like you said, customer acquisition strategies versus kind of a standardized metric of blanket of it being on Amazon, right?
Yeah, right. There's a canonical source of data in Seller Central, right? I mean, so from an acquisition standpoint, that allows us to move quickly, right, and with confidence.
Yeah.
Right. So you're always trusting, but you need to verify, right, when you enter into an acquisition agreement. So with Seller Central, right, you get access. You can, we got a great team. We've built a script so we can download and parse transaction reports and create, a 100% accurate P&L in a matter of hours.
Yeah.
Right. Most people, they have to hire an accountant, and they got to dig through everything, right? And there is part of that, right? There are general expenses that are outside of outside of Seller Central. If you're running at Facebook ads with a credit card, or you have employees. I mean, there are other auditable costs, but for the most part, we get a general sense of, all right, this is the profitability of the business in a pretty quick manner. Which is very unique. in terms of acquisitions and kind of a roll-up strategy of running the same acquisition playbook.
Yeah, very interesting. So, I'd like to look at a little bit more specifically now, like at Thrasio, how do you guys approach opportunities? Is there a certain, obviously Amazon, but, is there a certain vertical or industry that you look at, or categories that you consider yourselves experts, or your team expert operators? Or do you mainly look at things more broadly, like, business fundamentals, overall stability, customer stickiness, if you will, repeat buys, ratings, that kind of broad health of a company? Or do you look at, maybe a little bit more narrow?
Yeah, I would say it's a pretty good mixture of the two. Definitely more of the latter. So, we're looking for industry leading position, right? And we kind of define that as, I always say kind of R cubed, so reviews, rating, and ranking. So do they have, the top reviews, top 5 review quantity, right? I mean, everybody, has probably, broad generalization, most people probably listening have shopped on Amazon, right?
Not on
Bezos.
No,
Yeah. Bezos' annual letter, he called out, I think it was like 26% of prime shoppers make their purchase decisions in under 3 minutes.
Yeah.
Right. So what are they doing? It's an intent-based platform, right? 70+% of search is unbranded, and it's a utility intent-based search, right? So you're searching for an umbrella, you're searching for a wine corkscrew, right? Since there isn't tons of brand power yet, and equity yet on the platform that's in front of you, right? Everybody just has decision fatigue in their day-to-day life, right? And so the beauty of the platform in the marketplace is it helps you make the decision, right? Yeah. You have a problem, you have a need, it shows you the solution, and you have that trust and that group, group buy-in of those reviews and the rankings that allow you to just quickly make that decision, right?
Yeah, like,
so that's kind of the beach
for for other people as well, and is that
right.
Can solve it for me, right?
Yep. Right. So that's, what we look for, that's the first thing we look at, right? So do they have, we call it beachfront real estate in their respective category? And then there are all the other attributes that, fall into place. Like, is it repeat purchase? Is it a high ASP? Do they have enough margin to ramp advertising spend? All those things fall out. In terms of categories, we have, our broad thesis too is everyday stable demand products. So, that does lend itself to certain categories, and we have focused mainly on hard goods to date. So we don't do a lot in, beauty and supplements and nutraceuticals or food, broadly speaking, yet. I think we'll probably venture there in the near future. But there are risks of, higher risks around compliance and, product integrity and things like that, we want to make sure our supply chain is completely compliant, that there's no harm in the ingredients, and that they say what they are, and setting up QC, for all those products, and making sure that they live up to, our standards, product standards. So basically it leans to kind of focus on like home and kitchen, right, is a big one, sports and outdoors, pets, auto, kind of, more in those areas than industrial or office or food and beverage, etc.
No, interesting. Thank you. So within the Amazon ecosystem, there's, different ways that one can sell. Correct me if I'm wrong, but it seems as though Thrasio focuses on FBA. Is, maybe, I guess, briefly, for those who aren't familiar with FBA, maybe you could give a very, very short description, but then to answer the question, why is the focus towards FBA?
Yeah. So the origins of Amazon, so there's basically 2 mechanisms of selling on Amazon, right? You have first party, which is FBM, right? Or not FBM, vendor, let's call it Vendor Central, it's called. So first party Vendor Central. That model is Amazon buys your inventory for you. They act as a retailer. They're the seller of record, right? They're putting their balance sheet at risk by buying your inventory, and then they get to control price and the listing and all that, right? Then you have 3P, which is Seller Central, which is within that you have FBA, which is fulfilled by Amazon, and you have FBM, fulfilled by merchant. So over time, right, Amazon, I think, realized that, hey, this is capital intensive. Not only do we have to build out the infrastructure, the fulfillment centers, networks, distribution centers, et cetera, but we also have to buy the inventory and take on that risk, right? Over here, they're like, well, let's, we're still going to build out the infrastructure and logistical network, but why don't we just charge people for it? And then they'll supply the inventory, right? So over time, you've had this massive shift where it was 100% 1P, and now it's like 35% 1P and like 65% 3P. And when you're in 3P, right, fulfillment by Amazon is basically you're responsible for shipping your inventory into one of their fulfillment centers, and then they'll tell you which ones, like how many units to ship to which fulfillment center, or they'll take it and then they'll disperse it using their own algorithms. So that's the model we do at FBA. And the beauty of that is, you don't have any infrastructure typically, right? I mean, we have a 3PL network, third party logistic network globally that we use. So we bring in the product from, our global suppliers into our 3PL, and then our 3PL either ships into Amazon, or if we're running D2C sites, they'll do our D2C fulfillment as well. And so that's the model. And the beauty of it for Amazon is, right, they kind of take a 15% referral fee. And then depending on your product price, let's say the average product's, $22 to $25 on Amazon. And then it's another 9 to 12% of revenue for that pick, pack, and ship and storage. Okay. So that actual fulfillment piece of it. So you kind of are operating with a pretty standardized margin when you're with Amazon, right? Anywhere from 25 to 30%. And that allows you to flex and, drive growth and profitability elsewhere. Whether it be supply chain cost savings, marketing, advertising efficiencies, price, whatever it may be. Because it's kind of built in and standardized to a degree too. Yeah, right. Whereas again, if you're doing D2C, and we do that, we're building a lot of Shopify sites, et cetera, for the brands that we're acquiring that didn't have them, and testing D2C, not only just the direct to consumer relationship and trying to own that, but the flywheel effect of Amazon, right? We're doing a lot of really neat testing around that, and seeing some really interesting insights. But when you're doing that, you got to go pay and acquire the customer. You don't know what that's going to cost you, right? It could cost you 90% of revenue, right? You just don't know. Yeah. And for a lot of products that are one-time purchases, unless you have a huge brand and where you can drive up average order value of your basket, it probably does not make unit economics, sense to actually go D2C and have a site and fulfill. Yeah, and there's also like seasonality that can be like put into that as well, in terms of like your overall cost to get a customer in Christmas time or whatever. Yeah, like what keyword you bidding on, and like the cost goes up dramatically. And if it's one-time purchase. No, definitely right. If you're supplements or kind of repeat purchase type products, having or if you have a broad portfolio and you can build up a great customer list and you can upsell and cross sell too. But I'll tell you, I've looked at a lot of businesses, thousands over the past 3 years. I've seen very few that have successfully built, profitable D2C brands at scale. Yeah, interesting. And my next question, and kind of you touched on it earlier, and came across this in preparing for this discussion. It's like more than 3/4 of Amazon searches are unbranded, right? So seeking generic products rather than brand names. In other words, consumers are searching, running shoes, not Nike, Adidas, Puma, for the most part. From the individual operator's point of view,
how is this a major advantage for people that are, starting an Amazon brand and looking to run an Amazon business?
Yeah, it gives you a chance, right? I mean, that's really it. It gives you an opportunity, right? So Amazon's algorithm, right? I mean, it's a search engine at the end of the day, just like Google is, right? I mean, they basically usurped Google's power on the shopping and product side of the internet, right?
Yeah.
Like everybody used to go to Google and you type in spatula in Google.
Yeah.
Now you go to Amazon and type it in, right? Because it's a purchasing platform, but it's also just at the end of the day, it is a search engine. So within that, right, lies power and opportunity. Because if you're a new brand that's like, if you just think about from Amazon's perspective, right, if they just put the top rated products on the page for every search result, you would just get a stale catalog, right? Because now you have a lot of those products have been selling for a couple of years, right? And they built up that cachet. But then, if you're selling Bluetooth headphones or whatever it may be, technology changes, right? And products iterate, and there's life cycles to those products. So Amazon constantly is showing new entrants and new products. That's why if you go and search, let's say you search umbrella, you're gonna on your first page of search results, you're gonna see products with 2 reviews, with 3 reviews, with 5 reviews, right? They're testing. They're giving you a chance. They're giving that product a chance to get in front of consumers. And then ultimately it comes down to conversion rates, right? Can you, are you making sales? And if you're not making sales, you're going to, they're going to de-rank you. They're not going to show you on the next, the next relevant keyword and the next one and the next one and the next one. And so when you invest a lot of time and energy in building a great listing and it's a high converting listing and has that potential, that's where you kind of have the winners, because then you get caught in the algorithm, and every fifth person that clicks on it is converting, and then Amazon starts to spider you out and show you to more and more keywords and tail keywords that are relevant. And that's really where you get caught in the positive momentum of the flywheel.
Yeah, like you said, it gives you a chance. So like those individual fragmented, small businesses relative, obviously, to the Nikes and Adidas of the world, or shoelace companies or umbrellas you've mentioned a couple times. I can't say if I know a main brand umbrella.
Yeah, maybe totes, totes, maybe, right?
Maybe, but it gives that third party seller a chance to get their foot in the door. That's super interesting. So I guess switching gears to maybe a little bit more of the sell side and current business owners, Amazon business owners, and looking maybe to pursue an exit. How do they know? Obviously, just broadly speaking from your experience, how do I know it's time to hang it up and look for an exit plan? And maybe a better way to put that is what are some of the common reasons you see people looking to sell?
Yeah. There's a few, right? One is just risk. A lot of these owners are solopreneurs. They've levered up credit cards, right? I mean, these are capital intensive businesses. You need capital and inventory to grow, right? And the minute you start starving the business of capital is when you start to decline. So I think a lot of sellers are saying, hey, I had a great run. This is getting to the point where, I'm not sleeping well at night. I got, $1 million of inventory on the water. I don't know when's going to get here and check in. I got 2 million, like their net worth gets tied up in their inventory.
Yeah.
Right. Because if you just think about it, right, let's just say you did $1 million in sales last year, and on paper you made $200,000 of profit.
Yeah.
Right? Like kind of 20% net margins, pretty typical.
Yeah.
So now, let's just say you made $100,000 and you kind of sold through probably $250,000, $300,000 worth of inventory to make, $1 million of revenue.
Yeah.
If you want to grow 50% next year, your working capital, if you're not increasing your inventory turns, your working capital, you need $150,000 of extra cash into the business and working capital to sustain the growth rate. Yeah. Right. Now you just made 200,000. Like you're plowing all that capital and those profits right back into the business to keep growing. Yeah. So oftentimes, the payday comes when you actually sell your business.
Yeah.
And up until until kind of we really started doing this at scale, there wasn't an option for sellers. It was, they weren't committed to reinvesting and growing because, you didn't know what was going to happen. So maybe they were afraid to really extend themselves and take on that risk. But now that exiting your business is a viable alternative, I think it's allowed people to have more confidence to like push for scale and growth, right? Those are the ones that have the risk tolerance to do it. So personal risk is one, right? Another one is just fatigue, right? You hear that, oh, I run it 5 hours a week, which I think is a great fallacy. I've yet to run across a seller that only spends 5 hours a week on their business.
Yeah.
But it's all right. Like I'm just selling this over and over again, and a lot of the sellers are just very inherently entrepreneurial and driven and want to like keep pushing the ball down the field and trying new things. And sometimes you just hit stagnation, and and then you get to the business to a point where your experience and your abilities have kind of tapped out, so to speak, and you need to make a decision. Do I go out and hire somebody? Do I start a new brand? Do I bring investors in? What do I do next? How do I take this to the next level? And that's typically, I would say 7 out of the 10 businesses we're buying, it's that they've like, hey, I've gotten this to a great level. I feel good about what I've accomplished. I want an exit. I want to go do it again. I want to do something different.
Yeah.
But I want to see it. I want to see continued success with the brand. And it's outgrown my capabilities. I don't know supply chain. I don't know how to do Facebook ads and Google ads and drive it back to I just don't know how to do that, and I don't want to invest the time and energy and capital to figure it out anymore.
Yeah, and that kind of goes to your first point of like, in order to do that, it's capital intensive. So they're all kind of like linked in a way. No, that makes sense. So if the goal is to sell, then right, let's say that's kind of like that way to get a liquidity event on your investment. What should Amazon business owners kind of be doing now to prepare? If it's in the medium future, near to medium future, and how do these things that you're going to mention help a buyer who's likely comparing more than one opportunity, of course, and how does that affect closing in general?
Yeah, I think for sellers, right? I mean, I've said this before, but I did this. Something I learned in investing, right, is ride your winners. And so when you have products that are showing breakout potential, focus all your time and energy on those, right? Because you're only going to have so many that reach that top tier status in your brand's portfolio, right? And that's what a lot of buyers look for, right? We're inherently diversifying our risk via acquisition, right? So we might buy, someone might, look at a company that has one product doing 5 million in revenue and $1 million in profit and say, holy shit, that's like super risky. Why would anybody run that or buy that? And we look at it and say, wow, that's awesome. Like that's a lot of operating leverage. Like if we bring that in-house and it's one product, we can manage that, very quickly. And there's a lot of leverage and knowledge that we can bring to the table to take it and investment to the next level and launch, halo products off of it quickly, et cetera. So I always tell people, 1, ride your winners, right? 2 is you get a real sense of, if your brand and your products really can fulfill their destiny, what does that look like? Does your brand have the potential and your business have the potential to get to 3 million in revenue, to get to 10 million, right? And then I always guide people, once you're 70% of the way there, that's a great time to look to an exit, right? Because as a buyer, you're also looking for opportunity and leverage that you can bring to the business, right? Yeah. So sometimes we look at businesses and we're like, wow, this is really optimized. Like they haven't launched any products over the past 18 months. They're ranking number 1 on all the keywords. They're running a healthy sponsored ad budget. Creative looks great. Product looks great. And we're like, yeah, that's okay. Like we're not going to shoot the lights out with that. There's not a lot of meat left on the bone for the buyer, for us.
Yeah.
To optimize it and generate right? Like real growth out of it. So it's interesting, some people are like, well, it's perfect. Like it's
turnkey.
Perfect. Yeah. And you're like, yeah, that's not as attractive to a buyer. Right. So,
Yeah.
so I tell people, get it 3/4 of the way there. And that's a great time too. And go through the mental exercise and really say, hey, can I get to number 4 position and number 4 market share in the market? And what does that look like on an annual basis, and be realistic about it?
Yeah.
So those are, and then in terms of just like administerial, like, readiness, you don't really need that much. A lot of the buyers now are very sophisticated in terms of how to build a P&L, how to look at the numbers.
Yeah.
I think there's a fear that you got to go out and sign an accounting firm and spend $5,000-$10,000 to get your books put together. I don't think you need that. It's more about the narrative, have a historical narrative of the business, right? Did you run out of stock? When did you run out of stock? What was, you think the impact of that was, right? I mean, that's, it's table stakes, especially over the past 12 to 18 months, that people ran out of stock, right? What was the impact? Conversely, did you raise prices, and what was that impact? And have a realistic view of, okay, I took prices, and, on Amazon, price increases flow through the bottom line at 85% incremental margins. So it's meaningful if you do that. I mean, we've had a lot of tough conversations with sellers saying, look, I know you sold a widget for, $10 and it was $12 3 years ago. And there's, Amazon's a deflationary marketplace. And then you were able to price it at 15 for 3 months because all of your competitors ran out of stock and you're sitting on a ton of inventory. That's not sustainable. Like, it's going to revert to $10, right? You got to figure that in. And we're not going to pay you for those earnings. So those conversations are becoming less frequent as everybody starts to really comp the big COVID bumps, kind of starting in March, April, May. We're kind of working, the pig's going through the python, so to speak, right now. On a lot of people's P&L. So absolutely. Those are the biggest things. And then, be ready, because, mentally, these, when you start to reach out to buyers, right, it's like chum in the water at this point, the marketplace, given all the capital out there, and people will want to move quickly. And it can go quickly. So make sure that just emotionally you're ready to have the conversations and kind of do a pre-post mortem. Okay, I sold my business. How do I feel? What am I doing next? Like, really start to think about that. Don't mentally check out. That's like the worst thing, right? It's not sold until it's sold. I've seen a lot of people do that, right? They cease ordering inventory. They ramp down advertising, just to save a few, $10,000 here, $25,000 here. And when you're, looking to exit for a multi-million-dollar exit, that it's not worth it, because you don't know what's going to happen until you really sign on the dotted line and the deal is consummated. So I've seen a few people do that, and momentum on Amazon cuts both ways, positively and negatively. And the worst thing you want to do is get in that negative spiral.
Yeah, totally. And you mentioned something before, which I think is important, is like, fortunes are made by kind of selling too soon, right? Like, you can never, exactly. You can almost reach an element where it's amazing. It's turnkey. Absolutely. But, as a buyer, you want to kind of really, hop in that driver's seat, so to speak, and actually, put your legs to work and ultimately see the upside, not just kind of flutter along.
And there's time and there's time value, right? Which is, I always tell sellers, I'm like, look, selling and building a business on Amazon is a very unique skill set, right? Mm-hmm. And if you have it figured out, it's extremely valuable. And if you're gonna stick around for a year, right, to maybe grow an extra 10%, 20%, like, you're better served selling your business and starting another one and using the time to build another equity, asset that you can monetize in 2 to 3 years from now, right? Which is why a lot of sellers just like to walk away, because they go do the same thing. Obviously you got to do a non-compete and things like that. Around the products specifically, but it's not like you can't sell on Amazon, you can't start a new brand or anything like that. So I think there's a lot to be said for. I mean, we're now buying second businesses from people we bought businesses from 2.5 years ago.
Nice.
It's pretty cool.
Yeah, that's really cool.
Yeah.
So I guess maybe specifically to, obviously you talked about the emotional side and kind of the timing element, but I guess specifically for in a buyer's eyes for due diligence, is it generally speaking, looking at Amazon account metrics? You also mentioned kind of like having D2C sites. Obviously, that would require looking at kind of outside metrics on an organic site. Maybe you could just touch on, what specifically buyers look for in general to these types of businesses.
Yeah, I mean, look, the diligence process, right, is, at least from our perspective, at Thrasio, it's the verification process, right? We're kind of trusting what we've been told and what we see, and we're just verifying that that's fact. Yeah. So we close on 90+% of the term sheets that we sign, right? So you sign a term sheet, it goes into the formal diligence, and then you sign your asset purchase agreement or your share purchase agreement. That's the legal consummation. Yeah. So 90% of the time when we sign a term sheet, we're actually buying the business. And that's important because we do a lot of, like my team up front, we do a lot of work. I mean, and we come to the conclusion, is this a business we want to own or not, right? We don't figure that out in diligence. We figure that out up front. And then when it gets to the diligence, there's a shade of it, right? It's like, okay, how bad do we want to own it, right? Yeah. And sometimes we might find something we're like, hey, conversion rates, they spiked to 60% for 2 months. They were probably doing something like black hat or doing giveaways, and that's kind of false revenue. We got to normalize for that, have a tough conversation with the seller, et cetera. I mean, we've seen it. We've seen it all, trust me. So there's nothing that, kind of gets by our team or that we haven't seen. And, like we know, the field we're playing on. So I always tell people, like, just be honest with us. Like, we've had accounts get shut down in diligence. We've had, a product catch on fire. I could write a book over the
scar tissue.
Yeah. Right. And we work with the sellers. We to try and still do a deal, because we're like, all right, well, we can course correct the business. We're going to operate an extreme white hat. We're going to improve product quality, like kind of all the things that we bring to bear as a global organization now. But so kind of, it's the verification, right? So it's really access, and then we look at those things, right? Like, how are the ASINs trending? What's the ASIN level profitability? What are conversion rates doing? Is there opportunity to improve those? Where are they driving? What keywords are they ranking on and driving the majority of their revenue from? Or are there opportunities there? And it's really refining the kind of the growth playbook and the growth opportunity set to hand over to our brand management team post acquisition. And that's really it. And sometimes, we always come across something, or a seller was like, a big one last year was like the wrong customs codes, right? As tariffs went up and everyone tried to skirt around, the tariffs increases with China. It was like, guys, like, one, it's illegal. You're either misclassifying your product, which is illegal, or two, they're reporting the production value, not the retail value, right? And so it's like, hey, we're not doing that. Like, we're not putting our company at risk by doing something illegal. So if you did it by the book, this is what the real profitability was, right? And you have got conversations around that. So that's it. And it's really, we have a series of diligence calls. So we want to really hammer on the supply chain and make sure that it's capable of handling significant volume increases post acquisition, right? Are you your supplier's number one client and you're 60% of their volume? In a world where we're doubling that in year one, that's concerning, right? So we kind of really diligence the supply chain, marketing and advertising. We just want to know, okay, what are you doing? What's worked? What hasn't worked? And kind of develop the playbook from there. General operations, right? Customer service. How do you handle return? Just things like that, right?
Yeah.
just think about if you were handing a business over to somebody, what they would need to know.
Yeah.
And that's kind of the process.
Yeah, no, awesome. And kind of circling back to what you're saying, you mentioned, log into Amazon and there's an umbrella for that has 2 customer ratings. So yeah, I guess the question is, at what point or does age, play a part in, how attractive an opportunity is to a buyer? Of course, there needs to be some sort of proof of concept and data to follow. I'm assuming that's the case.
Yeah, it's right. I mean, it's important to paint the picture, right? And know what you're buying from a buyer standpoint, right? Like the longer the history, the more confidence we have in, the product and its positioning within the Amazon, algorithm and the ecosystem, right? So if you buy someone that's been around for 6 months, were they doing tons of giveaways? How did they launch the product? I don't know. It's easy. You run out of stock once and it's going to collapse, right?
Yeah.
Like the algorithm's not going to pick it back up because it doesn't have that history versus a product that, is leader in the market. It's been selling on Amazon for 7 years. Like that runs out of stock, gets obviously deranked, gets in stock, it's back up in 3 days, like to where it was, pre-stock out. Right. So there's definitely value in history on Amazon and accounts. And a lot of times, right, it's the younger accounts and products, they're often most successful in exploiting new, niche categories. And those they might just not have the runway, right? Or they might, I mean, I look at a lot of businesses that are, growing at 200%. And it's like, all right, well, now they're selling in a very, what appears to be a greenfield market, but we all know that, Chinese suppliers and competition comes in and margins go away and, prices come down and collapse, right? It's only a matter of time. So that's why we really focus on how big is the lead, right? And is it assailable by competition? And so typically with younger accounts, they don't have that lead built up, so to speak, in terms of the reviews and the product rating and ranking.
Yeah, interesting. And I guess so. We just talked about kind of age. Next, if we could maybe touch a little bit about size. So there are millions of seller businesses that exist on Amazon. With about 80% of them, in what we could find, recording less than $1 million in sales. So obviously that the remaining 20% over $1 million, which is still a massive market. How is size looked at in terms of your guys' operation?
Yeah, I mean, we're not size discriminatory over a certain level. So we really look for minimum threshold of $1 million in kind of trailing 12 months revenue. And we'll look all the way up to, 150 million at this point. So kind of you could drive a truck through that, that lane, so to speak.
Yeah.
And it depends. It really depends. I mean, is a 75 million revenue business more attractive than a 5 million? Not necessarily, because the 75 million could have 2,500 SKUs, right? And maybe they have 1 or 2 that are doing, 2, 3, 4 million in revenue, but that's a huge operational burden, right? Like to run that thing. And it's probably got a team of 50 people, right? And that's, we will definitely take a look at it and talk about it internally. It just has a much higher hurdle rate than a business, to acquire, than a business that's doing 5 million and has 3 people running it, right? Like 10 products. Like that's a sweet spot acquisition for us. So, it'll increase. And I think we'll, at some point we'll probably make some large strategic acquisitions and things like that. But our kind of business as usual, I'd say that, call it our sweet spots in that 1 to 50 million right now in revenue. And we don't want to, as you alluded to, right? There's a natural pyramid of sellers and size, right? And look, the guys that are doing 50 million a year in revenue, it's a great business. And if you are spending, you got a team and you're spending 10 hours and it's throwing off, after taxes, you're taking home $5 million a year. That's a great business. I probably wouldn't sell that. You know what I mean?
Yeah,
Depending, and
totally.
unless I hit a point where I'm just like, I don't want to do this anymore.
Yeah.
But so it's really, people are all, there's all sizes and shapes of businesses. There's 30 plus thousand doing over $1 million a year in revenue. And we bought, a little over 100 to date. So still a large market out there.
Yeah, absolutely. So just transitioning a couple more questions, two more, and then we'll go into the social media questions that were submitted.
Great.
I just want to make sure I'm respecting your time with this that we blocked off. But the U.S. market is Amazon's largest sector in terms of sales, followed by some of the European countries. What do you believe, or broadly maybe Thrasio believes, are kind of some global opportunities for e-commerce in general? Is it the Amazon? Is it other platforms? Maybe you could just touch on that.
Yeah, I mean, look, we're participating in all their other marketplaces for the most part globally. I think there's a big opportunity for regional marketplaces, right? That you're starting to see build up. I would say Amazon's FBA infrastructure in Europe and UK it's lagging, and in other countries behind its US infrastructure. So I think they have a lot of investment and scale to do, right? It's interesting. You talk to a lot of businesses over there, and they're using their own warehouses, or they're fulfilling via 3PLs, not using FBA. So they're doing fulfilled by merchant because it's cheaper. So I think that's not the case for every business, but there's pretty good mix of them that's the case. And it could just be that was just legacy, right? They got set in their ways and they know how to do it that way, and they're afraid to go that transition to FBA. But I think there's a lot of runway, right? I think if you look at what Amazon's done in the US, it's nothing short of astounding. Setting up the logistical network. I mean, in a year from now, we'll probably all be getting an Amazon package on a daily basis, and the turnaround times just keep getting shorter and shorter. So I expect them to continue to forge ahead in those other countries, in Europe, UK, India, Japan, right? Like, we have an office in Japan, and the Japanese market is pretty, it's basically a trifecta of Rakuten, Yahoo, and Amazon, right? And like Rakuten's kind of clothing and accessories and things like that go on the body, and Amazon's like hard goods and things like that, right? So I think it'll be interesting, right? As they have to kind of usurp incumbency status in some of these countries, and so maybe Amazon in those countries will be a little bit more of, hey, these are the more hard good commodities, right? And all the regional marketplaces will find their own strength based on kind of the supply side. But we're looking, I mean, pretty much every country at this point, and have exposure to the Amazon marketplaces, but also in discussions with all the regional marketplaces as well.
Yeah, interesting. And you kind of brought this up, so maybe this isn't so much from a Thrasio portfolio point of view, but maybe like on an individual brand basis, how consumers shop in other places of the world definitely differs from how we do it in North America. And you mentioned like Amazon being very intent driven. Maybe that's not the case in other areas of the world. How do you see individual companies or brands adapting to these things in order to have success internationally?
Yeah, right. I mean, you got to start with the consumer in mind. I mean, just like any product or consumer driven, and consumer company, you got to start with the customer in mind, right? And it's figuring out how they're shopping. How do they find your product? How do they discover your product, right? I mean, Amazon, like for instance, in China, live shopping is massive, right? Does it ever take hold in the US? I don't know. It could just be that people don't want to sit on their phones and shop in real time. I mean, I know Amazon's testing it, and there's other platforms, social media platforms that are testing it. Instagram, obviously Facebook's testing, and we'll still see what happens. I think, I do think it's hard, which is why I think we're so bullish on Amazon. It's hard to change consumer behavior, right? So I think you're going to get, or you always have, right, in technological innovation, you always have early adopters evangelists, and then you got to, cross the chasm to hit the mainstream, right? And I think that's where, at least in North America, right, Walmart, Target, are having a hard time because they Walmart probably has the best chance, on the foods and grocery side, but they're just not going to be able to deliver products as quickly and efficiently and have the one touch and one click for a purchase that Amazon's built out.
Yeah.
And so I think, and it's consumer behavior. I've tried it. I'm like, all right, let me try Walmart, right? It's different product selection, a different process. It's so easy just to open up the Amazon app and have confidence that's going to be here tomorrow. So we got Skunk Works internally. We're testing all this stuff. We're trying to roadmap the next 3 to 5 years of the consumer purchasing patterns on, in all these different marketplaces and global, on a global basis, like what's going to work, where do we want to be, where are the growth drivers, who are the winners going to be. And our ultimate goal is to, build a global omni-channel digital first consumer products company for the next age.
Yeah, awesome. Well, and thank you for that. And that kind of concludes the interview portion of our discussion. We'll now kind of transition to the few questions that we received via social media. Of course, we did get a lot of operational advice, people asking. So unfortunately, we kind of maybe reserve that for
I'm just the deals guy.
Yeah, exactly. So we'll stick to what we know. So I guess starting with pretty long tag name, NYSRPA Take My Energy Too asks, why should a startup begin with Amazon, harm its margins, starve itself of working capital, paying FBA fees to Amazon when sales are likely low, infrequent, and unpredictable, as typical with many startups?
So why start on Amazon? Can you just repeat the question, Joel?
Yeah, basically it's asking, with the upfront fees of FBA, why should a startup begin with Amazon, essentially?
I mean, it really depends on what your aim is and what you're building, right? If you're building a brand and really have like a passion-driven brand and brand equity you're trying to build, it might not be the best platform, right? Because it's probably going to be D2C and run a lot of targeted Facebook ads and Instagram ads, right? Like if you know who your customer is and it's very defined, right? Okay, it's a suburban mom that has an annual household income of $200,000 a year, et cetera. That's my target market. Then Amazon Prime kind of fits that, but that's probably not the best example. But then you probably don't want to just launch on Amazon, right? You're kind of going to be a minnow in an ocean. But I think a lot of the products that are successful really study all the reviews of the top selling products and they iterate, right? So our product development teams do this all the time. We constantly are reading our reviews. How do we make the product better? What are the pain points that consumers have? Why don't they like the leadership? Like the product that's the top most rated and they're rated 4.2 stars. Okay, how do you launch something that's better than that, right? And so I still think it's probably the most efficient way to launch a consumer products company. And again, I mean, I've seen numerous trial and error on the D2C side, right? So I think that the customers are there, and that's the main reason is they're there. You just got to get your product in front of them, and that's a combination of marketing, creative, and SEO and keyword ranking.
Yeah,
but it's the largest marketplace in the U.S. and I mean it's a great place to launch. I think it just takes more capital nowadays, right? It's not the heyday of 2010 to 2015.
Yeah, totally. Okay, thank you. At Bankers Banks asks, probably a question that you get a ton. How much do buyers typically pay to buy out a successful Amazon business. I'm sure this is, how long is a piece of string? How expensive is a car? Obviously, it varies. But
it does
maybe
vary.
you could give kind of a range.
Yeah, I would say in general. So in general, right now, kind of right, everything's valued on a trailing 12 months profit. Typical multiples. So there's usually different phases of payments. So there's like the upfront payment, kind of stability payment, profit share. But overall, right, like the upfront payments are ranging anywhere from like 3 to 4.5 times trailing 12 months profit. And then you ladder in additional payments on the back end of that, to where I think it's you should think about potentially, depending on the buyer and what they do with the business, 4 to 6 times kind of all in is pretty realistic market pricing right now for Amazon businesses.
And have you seen that kind of go up in recent years?
Yeah. I mean, just supply demand.
Yeah.
Right? Just like any market. Early days, it was we were probably paying 2.5 to 3 times upfront.
Yeah.
But there weren't a lot of businesses for sale either, because it was just a new marketplace, right? So you didn't really have your pick of the litter, so to speak, as a buyer. And now, just COVID, everything, like both sides of the marketplace in terms of transactions and buying and selling businesses have rose exponentially. Maybe, we have 75 plus businesses we're assessing at any given point in time. 2 years ago, that was 5, right? So
yeah, totally.
There will be some equalization to, like, normalization, I think, to pricing. It's probably a little bit of a bubble right now, but.
Mm-hmm. And you kind of touched on this, but I'll ask it anyways. But long_time_seller says, thanks for doing this. My first question is, can you get paid 100% upfront? If not, what percentage goes to installments, and what are those conditions generally?
Yeah. Depending on the business, maybe, right? But the diligence cycles are done quickly, and we're not going to unearth everything, and most buyers don't. So we're also, for stage payments, right? There's, general reps and warranties that any seller of a business adheres to, right? Like, hey, these are the numbers. I haven't done anything illegal, et cetera, that's going to impair the business. So there always is a little bit of a staged, payment, just to protect the, recourse from the buyers against any fraudulent representations that took place during the diligence period. But generally speaking, I'd say 65 to 80% is generally upfront.
Okay. Awesome. Last couple here. Corruption Studios asks, how are you able to detect whether the products that the brand is selling will have patent issues in the future?
I mean, we have a large IP team. We have a legal, I think there's probably like 5 or 6, maybe even 7 people on our IP, like bona fide IP lawyers. So we do a lot. We do a lot of work around that. How enforceable is it, right? The biggest is for Amazon in particular is trademarking. Make sure you're having any trademarks.
Yeah. Okay. At jtarwin98 asks, what would you say to potential sellers that are concerned or nervous about not receiving their earnout? In other words, should a buyer not operate the business in the same capacity as the seller has, the company may not hit performance metrics at no fault of the seller. I'm sure this is one that you probably come across. People are a little concerned about.
Yep. Yeah. I mean, I understand that, right? Which is why we kind of try and give a big value up front as well as part of the economics of the deal. And you really got to trust the buyer and who you're selling to. There's a lot of upstarts that are out there buying businesses that don't have zero operational experience. And I would be skittish, selling to them. For the early days, I mean, we kind of pioneered this deal structure in early days. People are like, how do I know you guys can be around to make payments? I'm like, yeah, it's a great question. I can't tell you that. Now I can, obviously. Yeah. With the momentum that our company has, but early days, I couldn't say trust us because it was a legit question. it's the same around performance, right? Now, and again, it's, some people, I talk to people like, well, I'm not putting any value in that. And I say, that's fine. We'll still pay it to you, but it's your prerogative to view it how you want to view it. So some people say it's a nice to have if I get it, but I'm not going to put any credence in it. And some people say, really bank on it and want to know what your plans are for growth and things like that. And they want to stay involved as a consultant, et cetera.
Yeah, interesting. And the last one I have here is from @TheMogulSkier. It kind of is to what the last thing you just touched. What's their plan for seller involvement, and company employees? No right or wrong answer per se, just curious. Do you have the seller involved post-close or not? What happens to employees? Are they given opportunities to grow in the bigger organization? And is there ability for the seller to get involved as an advisor or in peer groups? And I would assume that's kind of a two-part question because it really depends if there's a staff or not. Is it, a one-man show, or is it, that $75 million business that we were just talking about earlier? Obviously, there's a different in transitions.
Yeah, I would say, right, it's a la carte, right? Early in the negotiation, if the seller says, hey, I have all these products I want to launch, I want to stay on, great. We bring sellers on as consultants and advisors to their specific brand for a period of a year or 2 years. And maybe we set up a side deal where you get compensated based on products you launch with our team and aiding our team on that, right? There's a lot of institutional knowledge that sellers obviously bring to the table with their brand. So we don't want that to be lost. And if there's an opportunity for both parties to work together and, make the business more, profitable and higher growth, we're open to that. Larger deals are just more complicated. I mean, we've taken on, 15-person quality control teams because it was integral to the success of the business, right? So, we're not, buy it, rip everything out, and just like take out all the operating expenses. I mean, we've front loaded our entire organization to do that. But if we think it's going to be detrimental to the growth, we will 100% work with the sellers. And if they really want to, we're definitely open to that. We're constantly hiring. I mean, we're onboarding probably 50 people every 2 weeks. So we're always looking for great talent. So I just think some people are entrepreneurial, right? And they're like, oh, I don't want to go work for a company after running my business they don't, that oftentimes they don't have to work right after an exit, at least for a period of time. So we're open to it.
What about the employees? Let's say it's a
similar
20-person team.
Yeah, similar. I mean, it's, if we go through diligence, we're like, wow, these people are integral to the success. If it's just, hey, they work in a warehouse and we're going to transition to 3PL, then obviously we're not going to require that. But it's really, the question should be, how integral are they? Can someone else do this? Can someone else get trained on this quickly? Is kind of a good barometer, right? Like we're talking a lot of businesses now that have like wholesale, right? And it's a place we're moving into, getting products into physical brick and mortar, and that's expertise. We don't necessarily, we have a few people, but we don't have massive teams. Yeah. And so if we look at a business that has a massive team, that would be attractive to bring in.
Yeah. Amazing. Yep. Well, that concludes the social media Q&A. Thank you to everybody that submitted a question, although we weren't able to answer it. And like I said earlier, a lot of them were around operations. We'll probably have a follow-up discussion with somebody in your team about that. But thank you to everybody. Ken, I'd like to end and see if there's any questions I neglected to ask, or if there's any messages you want to leave with the audience.
No, it's I still think it's early days of Amazon. It doesn't feel, depending on where you're at in the ecosystem and how long you've been selling on it or not selling on it, it can feel like they've completely taken over. But I still think it's a great time to be a seller. Great time to sell your business too.
Amazing. And where can people find you online?
Just our website. I think we actually just turned it over to thrasio.com recently, which it was thrash.io, and everybody started calling us Thras. But email ken@thras.io. So we still have that. LinkedIn. Yeah.
Okay.
I'm on LinkedIn, Facebook, whatever.
Amazing. Well, this has been a ton of fun. I really appreciate you carving out the time to provide valuable insight on today's topic. And lastly, thank you for everybody tuning into the video. If you're looking for more information around buying and selling private companies, check out our tools, resources, and blog at tresle.com, tresle.com. Further, any future webinar suggestions or topics or guests, shoot us an email at hello@tresle.com. Thank you so much and take care.